In case you missed it, silver just broke a new all-time high, topping $52 an ounce on October 13th. And at the pace this market's moving, that number might already be outdated by the time you watch this. The surge feels familiar. Echoes of 1980 and 2011 when silver shot to the moon before crashing back to Earth. But this time, the setup looks different. The underlying fundamentals have shifted, and we may be witnessing the final days of cheap silver. If you're one of the many who want to know what's really happening in precious metals without the hype, you've come to the right place. Subscribing is a small but meaningful way to support the channel. Thank you. Silver's surge past $50 didn't come out of nowhere, and there's far more to unpack than we can fit into one episode. Supply chain shocks, regional disruptions, years of mining deficits, soaring demand, rising lease rates, thinning exchange inventories, and the broader gold rally have all fueled this record-breaking move. But before we uncork the champagne, it's worth remembering the history around this price range and what's really driving it now. Because if the underlying dynamics haven't changed, history points to a pullback. The difference this time is that the fundamentals appear stronger, and for holders of gold and silver, that might make all the difference. To the victor go the spoils, the rallying cry of warlords and gladiators, and just as true for historians. History is written by whoever gets to hold the pen, and that means the story often changes depending on who's telling it. When we look back at silver's explosive run in 1980, what we're usually handed is a sanitized version of events, a convenient summary that glosses over what really drove the surge and the crash that followed. The 2011 rally isn't much clearer. Some blame the Eurozone debt crisis, others point to the fallout from 2008, and still others argue that it was the government's response, the flood of stimulus and spending that lit the fuse. But the truth is, silver had been quietly climbing long before the crisis ever hit, rising from about $5 an ounce in 2000 to nearly $15 by 2007, a year before the collapse of Lehman Brothers. While the specific triggers are open to debate, the fundamentals tell a clearer story. Inflation naturally drives up the cost of hard assets, but in markets where paper derivatives dictate pricing, that adjustment doesn't happen immediately. It takes time, and usually a few catalysts for prices to reflect the real value that inflation has already set. Fiscal policy loads the powder, and the catalysts are just the spark that sets it off. In both 1980 and 2011, silver's rallies ended abruptly, and prices collapsed in dramatic fashion. Anyone who bought at the top was left holding the bag. But step back and the story looks different. The 1980 surge to $50 began a decade earlier, when silver traded between $1.50 and $2 an ounce. Even after the crash, prices settled around $5, still a 300% gain from the starting point. The 2011 run followed a similar pattern. It started in 2002, when silver was about $5 an ounce, and even after the correction it held between $15 and $20 for years, 3 to 4 times higher than where it began. Both rallies took roughly a decade to reach their peaks. The current one began in 2020, when pandemic-era policies pushed silver above $20 and ignited a wave of investment demand. No one knows when this bull market ends, but one thing seems clear. The era of cheap silver is probably over. Even a pullback might not send prices below $45, meaning what looks expensive today could soon be seen as the new floor. Conditions are different this time from past rallies, and that makes predicting prices far more complicated. If history is any guide, silver's move has probably run a bit ahead of itself. The data shows it's now trading about 30% above its 200-day moving average, a level that's only been hit 10 times before. Each time, support gave way soon after, leading to an average pullback of roughly 24%. Now, if that pattern repeats, the silver could slip back toward $40, maybe even a touch lower. But that wouldn't necessarily mark the end of the bull market, just a correction within a much larger trend. And this time the market itself looks very different, and a pullback is far from certain. The market structure has changed. It's no longer a guarantee that price setting is determined by Western markets. The recent gap ups in price have occurred overnight, while Western markets were closed and the Asian trading session was active. Some analysts have told us the exchange in Shanghai has seen upwards of 70% more trading volume than Western markets at times. The global silver market is deeper, more liquid, and with more active participants than during any previous rally. Spot prices have now overtaken futures. Under normal conditions, futures trade at a premium to spot, but since silver broke above $50, the opposite has happened. Spot has been running about $1.50 higher than futures, putting the market in backwardation. That tells you people would rather have silver in hand now than a promise of delivery later. Typically, silver trades in contango, meaning the market expects higher prices down the road, and when that flips, it signals stress, a worry that there may not be enough silver available when contracts come due. But supply fears aren't the only reason spot can rise above futures. It hasn't escaped our notice that price discovery is now happening during the Asian session, and that the Shanghai Gold Exchange, an over-the-counter market, is driving it. Unlike futures exchanges, the SGE trades physical bullion, and it's been growing fast. Shanghai Metals Market reports that in 2024, trading volume on the SGE surged nearly 55% year over year, while futures volumes rose only 15%. The World Gold Council calls it the largest physical spot exchange on the planet. In August alone, the SGE delivered over 1 million kilograms of silver and traded close to 8 million. To put that in perspective, that's about a quarter of global annual supply in just 1 month. So far this year, the SGE has delivered more than 530 million troy ounces, over half of total expected global mine output. With price setting occurring in Asia and spot prices leading futures, it begs the question: has physical reality finally asserted itself over the paper market after years of stress tests? Are we witnessing a repricing of silver under China's terms? Or is this a temporary rally driven by regional supply dislocations, overseas delivery challenges, and arbitrage activity? Only time will tell. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.